Today I am going to share with you an A-plus trade setup for the Nasdaq 100 that repeats several times a year and is highly rewarding if you know what to do. So stay tuned, watch closely and take notes. If you like it, you might even share it with friends that love to trade the Nasdaq. Our focus will be on Nasdaq's Friday regular DR sessions. Please always set your time zone on TradingView to New York local time. It won't be affected by daylight savings, etc., and you're always good to go. We are focusing on a specific confirmation time window where we want to have a short confirmation between 10:30 a.m. to 11 a.m. The probabilities which I will share with you will not include any confirmation after that particular time window. Once the confirmation happens during that specific time window, we are dealing with 346 datasets in total where this unfolded over the past 17 years. The first thing to note is 85% of those scenarios in the past, the DR session turned out to never close above the defining range within the session, also called a DR true session. Because we assume that the DR session holds true, we will check the true box and QuantX will only show historical data for true scenarios. This brings us to the next step, which is identifying the optimal time, retracement areas or price, and lastly a high probability target for the session. For the optimal entry time window, we will be focusing on the first mode from the left of the distribution up until the median time of max retracements. As you can clearly see, most of the maximum retracements happen specifically from 10:45 to 11 a.m., which is the mode. The median time of 12 p.m. marks the time where historically 50% of maximum retracements during the session happened. The mode and the median time mark the time window we want to look for entries. Now that we identified a strict time window for entries, we can bring that onto our chart. This means everything after 12 p.m. is not of interest for our time and price-based trading, and no entries should be taken after. Before we move on to the retracement areas, it is important to know the statistics for a retracement back into the defining range as well. While there is an 86.3% probability to see a retracement back into the defining range, the probability of seeing a retracement back into the implied defining range is slightly lower with 70.7%. This already tells us that price sometimes likes to just retrace back into the defining range instead of deeper into the implied defining range before making its move. But what exact advantage does this give us? When looking at the maximum retracement distribution, which is measured in standard deviations, we can clearly see where the algo made its maximum retracements in the past under these criteria. For example, the 0 to 0.09 retracement right here is, if we look at it on the chart, located outside of the IDR in this current example. Do you get what I mean now? It's a retracement back into the defining range, but not back into the implied defining range. So if we look again at the distribution, we want to go with the zones where the algo had most interest to retrace back into. The first one is considered to be from plus 0.09 to minus 0.3. It also covers the median and 70th percentile of max retracements. Another one can be considered from minus 0.51 to minus 0.7 for a potential second entry during the session. After that, there's a sharp decline in the data distribution, also referred to as a cutoff. Putting these two retracement areas on the chart already looks very promising, right? Let's see what we can expect with a high probability as a target for the session under these criteria. 0.6 to 0.79 is standing out by being the mode in this distribution. I would nonetheless prefer the 1 to 1.09 standard deviation level as a target, as it lines up with the 70 percentile. Here's another reason why. When cross-filtering the maximum retracement areas just based on the first retracement cluster, we can see that for entries in the retracement area from plus 0.09 to minus 0.3, the one standard deviation stands out in the target distribution. That's a very cool feature in QuantX, isn't it? That means that entries especially taken within the first retracement cluster, the probability is extremely high that price will extend toward the one standard deviation level. With time price and a target area now on our chart, it's time to wait for a retracement to execute a potential trade. Price enters the entry time window and starts to retrace back to the IDR low in line with the closing price. With stops above the first retracement box, that can be your first bullet for the session offering 3.5R. After several opportunities, price reaches the median time of retracements at 12 p.m. This can also be a trade if you've missed it. Because the median time for max retracements is reached, you can assume that this retracement high is the maximum retracement for the session and place your stop just above it. Another potential 3.5R trade here. Price drops lower, reach the 70% target and even lower standard deviation levels. Let's look at a few other examples. When going back to 7th February Friday IDR, another trade unfolded from the first retracement area, which unfortunately didn't reach the target until the session ends. But you have to keep in mind that this was a no trading day due to news events like non-farm payroll. 2 weeks earlier, another short confirmation in Friday's regular DR session unfolded on the 24th of January between 10:30 to 11 a.m. Here you would have been stopped out with the first position, but the second one was a pinpoint entry ending in a 4R trade or even more, depending on if you would have been filled with a limit order. So to summarize, you only want to use this approach on the Nasdaq 100 only in Friday's regular DR session if a short confirmation happens between 10:30 a.m. to 11 a.m. Confirmations after that time window have different probabilities. You highlight the specific entry time window going from 10:45 a.m. to 12 p.m. No entries should be taken after 12 p.m. Inside that time window, you look for an entry anywhere between the first retracement box going from plus 0.09 to minus 0.3 inside the defining range, with stops a few ticks above the minus 0.3 retracement level. If stopped out, you can get a second opportunity for the session within the higher retracement box going from minus 0.51 to minus 0.7. Your target for the session is the 1 to 1.09 standard deviation level. Now go on to your charts and backtest it coupled with all the IDR basics that I've taught you so far on my channel. If you found this session insightful, please like the video and share it with your friends who trade the Nasdaq. These insights might be very helpful and sharing is caring. Let me know in the comments which assets you trade. I might drop more high probability setups for other instruments and I hope to see you in the next video.
We're gonna take on the world.